The story continues for Deutsche Bank, constantly sliding further down the hole as the real money moves out and only central bank intervention keeping it afloat. How long will it be until this bank fails? If it is to be rescued, how will the ECB actually save it? You came here for the truth, so let me unveil that for you. Today we're going to have our focus on the European markets, specifically Deutsche Bank. I want to look at this stock. I think it's an important company. It is one of the global systemically important banks. If this bank fails, it will take down the entire global market. There is no doubt about that. The question I have, and I keep asking, how? By what mechanism could this bank be rescued with? What could it be? It couldn't be something that's been done before. A normal bailout or a normal bail-in will not be sufficient. It's too big. And the counterparty risk, which I will show you in a moment, is simply greater than we've ever seen before. Deutsche Bank investors unshaken by U.S. stress test failure. Can you believe it? They failed the stress test, which is designed to make them all pass, so they all look just fine. It wasn't until after the financial crisis that they started admitting that these huge companies, these huge failed insolvent banks, were actually, in fact, in a bad situation. Deutsche Bank investors took a largely long view on its failure in this year's U.S. stress test, with its shares recovering on Friday from a record low hit earlier this week. I'll show you the charts just a second. Goldman Sachs said that the U.S. Fed issues with Deutsche Bank were, quote, long-standing and not new. The UBS said that the failure was not a total surprise. The Fed last year classified Deutsche Bank's U.S. unit as troubled, and Deutsche Bank shares had they've been falling in anticipation of the stress test verdict. But here we are, stress test happens, and of course it doesn't really mean anything until we enter the crisis. These tests, they are simply there to make the financial system seem like it's strong, but in reality it is entirely fragile. Shares in the German bank, which are down 42% this year, and it goes on. We're looking at 9.19 euros, and I have the chart here. In this one, it's just showing you just over 9 euro after having been just slaughtered throughout 2018. But take a look at this chart going back even further, and you can see that it is down significantly from its peak. Why? Why would a bank of this magnitude, so important, so massive, global reach, why would the stock be hemorrhaging? Well, I think there's something going on behind the scenes of the true weakness of this company. It's being exposed here in the stock's price. Usually you would have that weakness there and it could be covered up, but not in this case. Something's going on definitely behind the scenes here. Parting ways. Since the Euro Stoxx 50's last reshuffle in September, Deutsche Bank had underperformed this benchmark, pushing it into a potential exit from the index. So there's a lot of reshuffling that's going on today, and that is something that we see every so many years. Some of these big companies are wiped off of these major indexes, and it doesn't look good. They can lose a lot of money as a result. I'll show you an article about that in a second here, but you can see the difference obviously sliding downward and the effect that it has. At the bottom, just more details about that index reshuffle could cut Deutsche Bank off from billions. More bad news looms for Deutsche Bank. The sharp drop in its market value could mean an exit from a major European index, jeopardizing its inclusion into the giant, and it goes on. That was Wall Street Journal. I want to show you this. This is the systemic risk. This is the connections that this one bank has globally, all over the world. You can see at the top left-hand side here, we're looking at China in this area, the US, and so on, looking all around the world. I mean, practically every different major bank is in some way connected with Deutsche Bank. Bank of China. I mean, we're just looking all around. Goldman Sachs, of course. So they all have this counterparty risk Very, very important to understand how counterparty risk works. So you could have, for example, the debt of Deutsche Bank being owned by any one of these companies. What about the credit default swaps that we saw, how that caused a big mess? All these derivatives that this company has, at the top of my head, it was something, let's just say the last time I checked, I've seen huge numbers that varies in any given year, but 50 billion or 50 billion euro perhaps. Either way, the number is gigantic. And you look at this, understand who owns those derivatives. They don't necessarily keep them all. These are products that they sell. But what if Deutsche Bank starts to go down? Then these other companies start to lose as a result. Then you have the connection with these companies. So who does Wells Fargo integrate with? And you would see those connections. And they go off. And then those companies, whoever that might be, has connections with other companies. And we saw that. We saw what could happen during the financial crisis, how bad it can get very quickly because of counterparty risk, specifically credit default swaps being at the center of all of this. But have no fear, because the Deutsche Bank CEO said that we won't get rid of our US unit despite failing Fed bank stress tests. Okay, everybody be calm. You know that when the CEO comes out and has to send a message that we have a problem, that's usually the time in which you need to worry. Whatever it is that they say you shouldn't be worried about, that's exactly what you should be worried about. The Fed says it saw, quote, widespread and critical deficiencies in the bank's capital planning controls. But when I talk about this, well, I'm just inciting fear, but here's the Fed saying that about this particular company. Looking at this, I take it the exact opposite way that they promote it. As I just said, whatever they say, I look at the opposite. It's just a fact. They are always trying to give this level of stability and a sense of, calm to the markets, but that's usually when they know that something is really wrong. Okay, we're going to switch gears here. The ECB mulls twist. You remember Operation Twist? Something that they tried to implement in the US in order to get the market going. It really didn't have much of an effect as far as I'm concerned. The markets were not exactly stable during that period of time. It wasn't until they issued QE3 that we really saw the markets start to come up. But here we go. The ECB mulls small twist to keep borrowing costs low. The ECB is considering buying more long-dated bonds from next year to keep Eurozone borrowing costs in check even after it stops pumping fresh money into the economy. They're suggesting that they're going to stop their quantitative easing methods. I don't think that's going to happen, but we'll see. If they're ready to crash the economy, they surely could do that. This move would be reminiscent of the U.S. Federal Reserve's Operation Twist of 1961 and 2011, which saw it replace short-dated paper with long-term debt to lower market interest rates and boost an ailing economy. That's what they tried to do. The ECB is going to try and copy that. They'll try to have an effect. This is all really at a time when they need to be printing more money. That's the only way that they can rescue the market, and there will be no saving this market without that. That's just a matter of fact. If they want the economy to continue to go, well, they're not going to get that with quantitative easing. So I need to understand where we have this separation in truth from what they tell us in the media and what is actually truly real. The ECB's case, it would be aimed at limiting the natural aging of its $2.6 trillion euro bond portfolio and keeping a lid on long-term bond yields. Okay, this is not going to end well. It's just a simple matter of fact. Here's a chart showing you the ECB's bond purchases by sector versus the remaining maturity, and it is to note that we are here, as time goes on, watching those bonds coming off, maturing. There are all different kinds. You've seen with their CSPP program, for example, which is relatively new in comparison to some of these others, where they have massive quantities of these. I mean, they're buying every month, going to the market, going in and buying up billions of dollars worth of these companies, bailing them out because real money is fleeing. and nobody seems to be concerned. One of the things I want you to just keep an eye on, not just the Federal Reserve's interest rate, not just what you see out of the ECB, the Bank of Japan, and so on. Always keep an eye on LIBOR, okay? Because we have over $300 trillion worth of assets, so-called assets, that are trading using this figure, okay? So don't just look at the Fed, don't just look in the US, look at LIBOR. It is critical. So you could see that on the Fed's website. But anyway, on the Fed's own website, they show you the LIBOR rates. There's a 1 month, 3 month, 6 month, 12 month, and so on. But I'm just showing you the 1 month, and you can see that it has increased as well. Look at the other factors, all the different months, and you will see the same situation. Since the financial crisis, we saw this stagnation, and then they all joined together and started to increase interest rates, and they have to, but ultimately increasing them is going to put a big roadblock in front of the markets. There's no doubt about that. Now, if you found this video informative, please give me a thumbs up. Giving me a thumbs up supports the channel. So I need to see your thumbs up. I appreciate it. Thank you. Now, if you want the financial education that was not taught to you in schools, these 2 books have it all. Okay, you're going to be able to learn so much. You're going to be able to dissect what's going on in the media. You're going to be able to look at the actual statistics and understand them from the very basics. You don't need to understand anything about finance, or if you do, it's all good. These 2 books have it all. Take a look at Amazon. Links are in the description of this video. If you're more interested in the audiobook version, you can get that at themoneygps.com.